Morning, everybody, and welcome to Introduction to Real Estate Investing. And this is lesson 5, our final lesson for this course, and a primer for our next course. And what I'd like to do is just jump right in and get started. You know, I was trying to sort of formulate in my head what is the best way to wrap up the course at the same time and give a really good solid takeaway. And I think that the start of lesson 5 is really sort of an encapsulation of the entire purpose that that we created this course and the lesson plans that support the course. And we're going to have another course that starts next week, the Advanced Principles to Real Estate Investing, where we're going to build on that. But let me start with the average investor in real estate. Their desire and intention to invest in real estate to make a profit, as well placed as that might be, the challenge is that very often it falls short of the expectation and it underperforms for a host of reasons. And this is what I'm going to cover a good part of lesson 5 today. Why do these things work out the way that they do? Or why do we end up not making as much money as we thought? And it can all come down to the approach and the discipline that it takes to be a successful real estate investor. Susan and I have built roughly about a $6 million real estate portfolio that has less than $800,000 of debt, and it appreciates in value over $500,000 a year. In the next 5 years, it'll appreciate at least another $2.5 million. And we're adding again to that based on not only our investment strategy, but our investment objective and philosophy. Our philosophy for multifamily is to provide clean, efficient, affordable housing, period. That's our philosophy. Our objective depends on the property and depends on a few other factors. And that's really what I wanted to dive into in lesson 5. So we're going to start with these 6 points. And really, this is where you can be one of the most successful real estate investors on the planet if you follow these guidelines. And it doesn't take a lot to get there. What it takes is the discipline to understand that your investment in real estate has to be disciplined. And if it's not disciplined, you are taking on an inordinate amount of unnecessary risk that you could lose your capital or lose the opportunity for your capital to grow safely. So every property in real estate should have an investment objective. And we're going to cover the 5 investment objectives of real estate investing. I was back in the real estate business before I got into the tax business about 45 years ago, and was crazy successful in multifamily, 2 to 4, 2 to 5 units. And still today, it's a sweet spot that has served us very well. But I can tell you that before you buy a piece of real estate, it should be able to meet one of these 5 investment objectives that we're going to go into today. Second, you have to have an organizational structure. In other words, how you buy and hold and dispose of real estate will decide how much tax you're going to pay or how much profit you're going to be able to keep that is not going to be subject to the tax. And that is critical because half or more of your profits can evaporate between income tax and capital gain tax. What you thought was going to be a profit, not even to come close because of these hidden traps. So before you even go to escrow, you should have a clearly defined investment objective and an organizational structure that is congruent with the investment objective. Then you go through a process before you even look at the property or make an offer. You do a pre-purchase analysis. We're going to show you what that looks like today. And it's a discipline that before I even go to look at a property or even talk to somebody about making an offer, I'm going to do this pre-purchase analysis, because if it doesn't scorecard correctly, I'm passing and I'm going to the next deal. I'm not going to waste my valuable time because it doesn't even meet even my most basic pre-purchase analysis standard. Then, assuming it does meet that, you're going to have a purchase analysis. Once I buy it, what does that look like? And what do those numbers look like? And does that make sense? Qualitative assessment. As an analyst, I study this for clients all the time, but as an investor, I apply it on everything that we do, particularly in real estate. And then, assuming that it meets those, I do the post-purchase analysis, because that deals with the holding period and disposition. In other words, before I even buy it, I know how I'm going to exit and get out of it. Is it going to be a property that I'm going to hold for 5 or less years? Is it a property that I'm going to hold for 5 or more years? What's my investment objective and what's my exit strategy? And I'm going to do that post-purchase analysis, because if it doesn't meet that, I don't want to have a big surprise that's going to give me a tax bill or some other unforeseen risk that is going to gobble up what would be my profit. And then I end with where I started. I ask myself, after going through that process, assuming all things being equal, does this property still meet the investment objective? And if it does, then we make an offer and we begin the negotiation. Now, in the next course, we have 5 lessons. I will get a little bit into the weeds on effective negotiation techniques that can really give you an edge when you're buying the property, and can really give you an edge when you're selling the property. And if you apply these techniques, it can mean the difference in how little more capital you're going to be on the front end when you acquire the property, or how much more you're going to be able to keep on the back end when you dispose of the property. These negotiation techniques are not unique or new. It's just when you apply them with the financial data, they actually move the needle quite a bit in helping you be more effective as a sophisticated investor. Again, applying the discipline as an investor. You try to eliminate as much of the emotion as possible. I get that we love the kitchen. I get, oh, the bathroom is so cute, or that the front yard has such great curb appeal. You know what? At the end of the day, if it doesn't meet the investment objective, it's not going to be something that I'm going to buy. It's just not going to, I'm just not going to do it. It has to meet that first, because at the end of the day, it is capital intensive and capital driven. And I'm not willing to put that capital at any unnecessary risk. I don't care what the curb appeal is. That's not the investment objective that's going to make a profit and help me with a strategy to keep as much of that money, because I've used a tax-centric approach in harvesting those tax attributes and financial attributes, because I'm a little bit more of a savvy investor than the average investor. And that's, at the end of the day, how I have used it to accumulate and build wealth, and want you to at least consider using it to build your wealth. And real estate is a great vehicle to do that. I'm going to fast forward through, and we're going to talk about today's lesson and the 5 investment objectives. Case study number 3 is really a spreadsheet that takes a combination of all of these factors and allows us to look at the data on a property and get a quick acid test if the property is even worth looking at to even consider making an offer. Because if it doesn't get past this, I'm moving on to the next deal. My time is too valuable to waste on a bunch of stuff that's not going to be relevant to meeting my investment objective. There are 5 investment objectives in real estate investing that almost certainly, if applied, will allow you to be a much more sophisticated and successful, financially successful investor once you understand the investment objectives and how they work. Every property that you own should filter through and meet your investment objective. And you can have different investment objectives for different properties. For example, the condo that we have on the beach in Del Mar, we have that, and it meets our passive income objective. We have a defined passive income objective, and that property meets that objective. And every day, it just keeps clicking on, clicking on. The property that we recently closed in December of last year on Perry Osea, the lot that we scraped so that a builder could build 14 units, that met our capital growth objective. We more than doubled our money and paid no tax because of the other structure of the capital growth objective to take the salary and the defined benefit plan and then put that capital, part of that capital, to work in the market, buying Amazon and NVIDIA back in December. And we've flipped that over, and it met the capital growth objective for the next deal. The Mohawk property met the asset diversification objective. It was a 4-unit property. It is now a 5-unit property. We bought it 5 years ago for $979,000. It's worth $1.9 million to $2.1 million today with 5 units, 2 garages that are rented out, and 2 storage containers or 2 storage closets that are rented out, and a laundry room that produces a couple of $100 a month. It started out making $70,000 a year when we bought it. It makes $125,000 a year right now, has almost no debt on it, and it meets every aspect of our asset diversification objective. We have diversified the asset to multiple streams of income, and we get more per square foot than anybody in that zip code. We get a premium increase on rent because we give the tenants one price, and it covers everything: utilities, gas, lights, sewer, water, trash, everything in one price, because we do a rent survey, not a comparable rent. Our property on Rogers Road meets the wealth preservation objective and will be a long-term conversion. And all of these properties in our real estate portfolio meet our wealth accumulation objectives that are clearly defined. So what I'm suggesting is that if you don't have a plan, you might want to consider building a plan that starts out with understanding each property that you're going to acquire having met the investment objective, which is your ultimate financial objective as it applies to each property that you're going to acquire and hold. How you acquire and hold the property will decide how you're going to be taxed, but that's only one part of the equation. How you dispose of the property will also decide how you're going to be taxed. And if you think you're going to make X dollars, but only because you didn't have a plan in place, you made Y dollars, you're going to be asking, why did I not make more money? And the answer is because you didn't have an investment objective that allowed you to keep more money. You had one that allowed you to make money, but you didn't have the other part that allowed you to keep any of it. And so that's the focus that really these courses are designed to help you improve and be more effective as an investor in real estate, keeping more of the money and not letting your capital dwindle away. All right. I want to talk a little bit about lesson 5 because the next course is going to be built around these particular principles. The objectives in real estate investing, we're going to go through today and give you an introduction to explain the passive income objective and its importance in real estate investing. It serves a very important role. We're going to describe the capital growth objective and how it influences your investment decisions. Sometimes you can take on unnecessary risk when you're using a capital growth objective. So you want to find ways to mitigate or reduce that risk, because capital growth is putting in 100,000 and figuring out you're going to take out 150 or 200,000. Well, the higher that return, generally, the higher the risk. But there are things that you can do to mitigate those risks, particularly in real estate. We want to understand asset diversification objectives and the role it plays in risk management. How you're going to diversify a particular asset, at the same time reduce the risk that you're taking on, so that you are not putting your capital at additional risk. We're going to talk about wealth preservation objectives and strategies and how to achieve it. Once you have wealth, you have to work to preserve the wealth. You want to work to accumulate it, but as you're accumulating wealth, you also want to work to preserve the wealth that you're accumulating. Remember, it's wealth accumulation is about adding more to that which I have. If I have one apartment building and I want to accumulate wealth, I'm going to find another apartment building. I'm going to add more to that which I already have. If I have one gold coin, I'm going to get another gold coin. I'm going to add more to that which I already have. Wealth accumulation is about accumulating assets that allow you to accumulate wealth, at the same time reducing risk that's unnecessary and preserving the capital by using tax-centric strategies so that taxes do not drain your wealth. And we've set this up so that we can do these lectures and podcasts, but we also have live class lectures that we're going to be offering here in San Diego. So that when you see that, that's just a little bit of an idea. It's a little bit different when we do it in a live environment. All right, so what I wanted to start with right now is the detailed objectives in the passive income objective, and just give you sort of a general idea about what we're looking at if our objective is passive income. I hear this term used a lot, and it's a term of art that unfortunately people throw around and don't really have an understanding of its, number one, that it's a term of art, and number two, its actual meaning as applied to investing. When people say, well, I want to create multiple streams of passive income, from a tax standpoint, that's probably the last thing you want to create is passive income, until you get to a certain point where passive income starts looking to be a vehicle and tool to help you do or achieve other financial objectives. If you understood that passive income is very restrictive or contraction oriented, it's very limited. You can only offset passive income with passive losses. You can't offset passive income with ordinary losses. You can only offset ordinary income with ordinary losses. So the character of your income is critically important. And if you're having money invested in real estate from a US tax perspective, all real estate investments are deemed to be passive unless and except they meet exceptions to those general rules. Every piece of real estate investment that you have is by default a passive investment unless that activity or that property meets an exception to the rule by a standard that has been defined. So that's really where the danger lies, because a lot of times people get trapped into a tax position not even realizing that they're trapped into a tax position, and they think they're making more money. And then lo and behold, they get ready to sell the property. And lo and behold, the next year when they get ready to file their tax return, which is too late to do anything about it now, then they discover when their tax advisor tells them, no, you got to pay all this extra tax because you have recapture of depreciation. It gets taxed as ordinary income. You don't have the passive offsets. So your $50,000 of profit or gain leaves you about $8,000 after tax. That's because we didn't have a plan to keep all of that $50,000 or more. Understanding that passive income objectives are important in real estate investing, so that if we're going to buy a property and we want it to meet those passive objectives, we better have an entity structure and a tax-centric model that allows us to do that in a way that doesn't put our capital at risk and is cost-effective in doing it. Some important items that involve passive income in terms of the criteria: steady cash flow. Passive income from rental properties can provide a steady stream of cash flow that can also go to support your lifestyle, pay off debt, be reinvested into other ventures. But again, that's going to depend on the entity structure also that you have. It can lead to financial independence. Generating sufficient passive income can give you replacement income. And if structured correctly, you can do it through your retirement plan or a defined benefit plan that's self-directed into real estate. There's a lot that you can do, and the passive vehicles give you the opportunity to do that very efficiently. It can also bring stability to your real estate portfolio. It gives you some flexibility that otherwise might not be there, because you have some passive income, like Del Mar is a passive income strategy. And so we can offset that by harvesting some of our tax losses against our passive income if we had any tax losses. So we've got plans. We don't have any tax losses on our stocks, but if we did, that would be something that we would be looking to offset some of that passive income. Also, the tax benefits. Rental income can provide a tremendous number of advantages. This is what we mean by setting up the property so that it's tax-centric. Everything that you do through that property is filtered through the lens of its tax attributes. And understanding the tax attributes are a leading and primary factor in your investment strategy, because it is the largest cost that you're going to incur in owning that property, on the front end, during the holding period, and on the back end. Also, passive income objectives allow you over time to create wealth accumulation through enhancing the wealth through consistent returns that are sustainable over time and generally are looked at as a preferred method of investing in our retirement years where we are less active and we want to just maybe collect the income and not have the hassle of dealing with the tenant's dog that bit the neighbor, blah, 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 and all the drama. The next on the list to consider in the passive are the methods that we would use to achieve passive income. And there's a host of things that we can do. Residential rental, single family, multifamily. Multifamily will always, always, always outperform single family for the fact that it is a completely different character of property. Not because it's better, it's just a different character. Leasing residential properties to tenants works differently in the financial analysis on a single family than it does for multifamily. Commercial rentals, 5 units or more, or a commercial building. Leasing commercial properties, office space, or rentals, 5 units or more, are very different in the financial analysis than, in other words, we evaluate a 5 unit completely different than a 3 unit or a 4 unit because it's commercial. Other rules attach and other rules, financial rules apply. Vacation rentals. This is becoming a very, very popular segment of the real estate investing segment. Real estate investment trust, REITs. We've invested in some of these REITs. When you look at the bond rates with interest rates going the way they are, generally REITs today, you can look at some pretty safe investments that yield with dividends somewhere around 7 to 9% annually, which is not bad. If you don't want to have any hands-on, then a real estate investment trust might be a preferred investment. It's what we call the grandma investment. This is where you would let your grandmother put her money because it's going to be very safe generally in those kinds of vehicles. Also, you have crowdfunding platforms that are extremely popular now, where you can participate in real estate investments through crowdfunding and different projects. So there's a host of different ways that you can generate passive income. This is just a sampling. I will tell you that the tax treatment is radically different on an passive income real estate investment than it is in something that is in one of the other classifications. The tax treatment is different. The financial treatment is different. And the rate of returns and the risk management is completely different. So if you have an investment objective to generate or create passive income, and you find a property that meets those objectives, you're already off to the races. Now you need to figure out what your entity structure is going to look like so that you can safeguard the capital and the gains that you're going to have so that you're not overexposed to the tax. The second is a capital growth objective. And in the capital growth objective, we have a lot of factors that can influence our decision on making that investment. Location, the type of property, market timing, renovation or development. This is the whole key was on the Periacia project on the vacant lot that we scraped. Do we want to renovate this property or scrape it to the ground? Spend the $53,000 to demo everything and get it ready for development and let somebody else develop it. Well, that was the highest and best use for us. We more than doubled our money. At the end of the day, we had a tax loss because of the management fee, and we paid no tax. We made over $650,000 in profit, parlayed that into the market, made another $400,000 in capital gains on Amazon and on Nvidia. And now we're going to sit on that and look for the next property that we're going to buy that's going to offset those gains. This is the whole purpose of capital growth, to grow the capital. But it's a little bit more risk intensive in the sense that, you really have to dig in and understand what options you have, and then make sure that your entity structure is favorable and tax centric so that you're keeping most or if not all of that money once you flip that property out and it meets your objectives. It's got to meet all of the objectives, including keeping a good part of that money. It's more of a long-term perspective. Generally, a 3 to 5 year window of time is not unusual for a capital growth real estate project. You're going to buy it and understand that you're going to probably hold it between 3 to 5 years to get everything in place. Risk management, it allows you to balance risk with growth and creates a more stable but sustainable objective. While the money is not in the real estate and working, it's going to be working either in treasuries, CDs, or it's going to be in stocks that are going to appreciate in value. And so that's where that money is parked right now. The profit portion is parked right now in the stock market and allowing it to continue to grow while we're now looking for the next deal for Periosea to acquire. It's not sitting in the bank, letting the banker loan it out and get all of that money. It's working hard somewhere else while it's waiting to find the next real estate project. That's all part of the capital growth strategy. The money cannot sit around idle. It's got to be working and producing something. Strategies for achieving capital growth are pretty straightforward. You have property development, you have value added. Mohawk was a value add because we had a 4-unit that's now a 5-unit. We diversified the asset, converted and rented out the garages, and converted and built 2 storage closets, and then built out and retrofitted a new laundry room. So we've created all of these other streams of income, which was a value add to the investment, and got all of the tax benefits and kept all of that income, not paid any more in tax. It requires that you do market research, which is something that is inherently challenging because people often look at the wrong information, or they're looking at rent comparisons. Rent comparisons are the worst way to decide rents. You really need a disciplined approach. As a valuation analyst, rent surveys are much more reliable, much more valuable, and will allow you to apply the discipline of a sophisticated investor where you're not putting your money at risk and taking a chance that you're going to lose the money. Land acquisition is a very strategic play. We would love to find another property like the Periosea property where we could go in, demo the house and the garage, get it down to the dirt, vacant lot, where a builder can come in and build 8 to 12, maybe 14 units and get $90,000 a door. So if we find another one in that zip code especially, we're definitely going to buy that with the same idea that we'll hold it 3 to 5 years, do the demo project, and let the capital grow as we do that demo. And we'll find a builder, particularly in San Diego with the housing shortage that we have, that will certainly pay $90,000 or more per door to buy that vacant lot and build those units out. And if we can get it for the right price and double our money again, even 50% return would be great. with a less than 3-year holding period. In other words, we have the investment objective of capital growth so that money can go to work and grow the capital. And because it's a tax-centric approach and we have the entity organization nailed down, we don't have a lot of exposure or concern of exposure to the tax consequences because we're using the tax attributes to our advantage. The third, and this one is really the one that I see the most opportunity in today's market that most average investors are missing in terms of the opportunity to diversify. Asset diversification objectives are clearly dollar for dollar. They will produce more and be more sustainable and less inherent to the tax exposure than almost any of the other investment objectives. They just give you so much more that you can do. Asset diversification objective is really spreading investments across various types of real estate or taking a real estate geographic location to diversify, or taking the asset itself and diversifying it. I'll tell you where a single family residence makes sense, and the only way that I would look at it. One, if I could scrape the lot and build 2 or more units and come out ahead, or 2, if I could take that single family and add a second one to the lot or build an ADU, an accessory dwelling unit, to convert it to a multifamily. Then it might make sense to have a single family that I could turn into 2 units, maybe even 3, because in San Diego particularly, you'd get a bonus density increase. And that's where maybe a single family might make sense. Clearly, with the new zoning regulations, you could get a 50 by 100 lot with a single family on it and literally scrape the lot, build a 3-unit on that, and come out pretty far ahead if you got the original purchase price in a certain range. So what it does is it gives you the chance to look at the property through a different lens. How would you diversify that asset in a way that would give you other types of income or other types of investment opportunities? And it actually is less risk intensive than some of the other methods because it gives you the option to look at the asset in different ways and analyze the financial metrics that's going to give you a pretty consistent return. And it's just going to depend on your risk tolerance and the time that it takes to convert the property to a diversified use. Some of those strategies involve the property type or mix. Some of it is geographic location. Like we like investing in real estate in San Diego where we can actually go see it. And we like it if it's in a transportation corridor because we know that we're going to get some bonuses in the zoning in case it turns out that we want to do some diversified asset combination or add to the building with ADUs or something like that. Also, the type of vehicle, REITs or mutual funds or crowdfunding is one way that you can do it. Those are more passive. But your entity structure or using a self-directed retirement account could be an alternative that would be very favorable in using this investment strategy or approach and balancing your portfolio for longer term retirement income. You have development stages that you would have to balance those investment between new development, existing, or renovation. Those have significant tax attributes. The fixed asset and repair regulations are a bit of a tax trap if you're not familiar with them. So you have to be a little bit careful when you're buying a property to renovate it and flip it, because inherent in that flipping strategy, you're going to have some hidden tax traps that could tip the balance or the scale against you and cause you to be treated as a dealer in real estate, which is almost fatal. You never want to have that classification, because it puts you in a tax structure that you can't manage it, and it will eat you up from a tax standpoint. So you really want to have an understanding of the exposure and the risk factors that are inherent in some of these investments, because flipping property, even 5 years ago, was a lot easier to do than it is today, because the regulations and the tax composition are a little bit different in how they're going to be applied. And if you haven't mitigated that through having an entity structure or some tax-centric strategy that's going to allow you to mitigate that, then when you dispose of that asset, you're not going to have the profit that you thought. You're going to have a tax trap that's going to come back, and it's going to bite you. All right, the fourth is the wealth preservation objective, and this is more of a longer term. We've got wealth accumulation, but once you accumulate it, you got to preserve it. And so real estate can give you a tremendous benefit on a sustainable long-term basis at preserving your wealth. And I go to the obvious strategy. I've got a lot of clients who, back in the day, like Susan and I, acquired Bitcoin. I've got some clients that acquired Bitcoin when it was $500. We got a bunch of Bitcoin when it was $5,000. Today it's 60,000 and change. I think in this next cycle, 12 to 18 months out, we're going to be looking at $300,000 to $600,000 per Bitcoin. So we've got clients that take their crypto profits in one entity structure and allow those profits to be fed into another entity structure that is in real estate and is part of their wealth preservation, because the tax attributes of the real estate are going to offset the tax exposure on the gains from the crypto and give them a long-term play that real estate is there to preserve the wealth that they've accumulated from the crypto. And every 2 or 3 years, when they sell a chunk of their crypto off and they go into a real estate project for cash, no debt, that's part of their long-term wealth preservation strategy. Is not going to be buried in a retirement plan or in gold or in silver or in crypto. It's going to be in real estate. And that's where they're going to hold their wealth preservation long-term, is in real estate. It is a hedge against inflation. I can tell you that a rent survey will absolutely outperform a rent comp any day of the week and protect you against the hazards and risk of inflation. It gives you long-term stable income and protects the asset through appreciated value, and giving you a lot of balance in terms of the equilibrium. In other words, your investment equilibrium. You don't want your capital underperforming. And so there's a ratio, an analysis that we do to understand how much, in terms of a valuation approach, how much your capital is really working and how much exposure you have to your capital, and things that you can do to enhance that wealth preservation. And it's really an important analysis that everybody should do, particularly if you're building a real estate portfolio. So those are some of the important factors that go into wealth preservation. Some of those strategies, I'm just going to give you a couple of them right here for right now. Stable income properties that are long term, they're going to be 5 or more years, and you have maybe a very different tenant composition. Like for Mohawk, our best tenant composition is an E6 military active duty, Marine or sailor assigned in shore duty for San Diego for the next 3 or 4 years. A student at San Diego State that's going into their 3rd or 4th year, or a grad student, or a traveling nurse. Those are our 3 preferred clients because they're more stable. They have the income for the rent. They appreciate one price and they don't have to pay for utility deposits or all of that. And we get, for that zip code, we get about 23% more than the average rent in rent comp in that zip code, because we provide a premium rent value to the property. It comes with a housekeeper, it comes with a gardener, all of the amenities, a nice laundry room. So we built all of that into the price, and so we get a premium per square foot in the rent. And it has turned out to be one of the best properties that we've got, because we understand that those 3 types of tenants are going to be our greatest value of tenant with the least amount of risk that we're going to have an unlawful detainer and somebody not paying their rent. And so it's worked out pretty good for us. Some of those strategies also, conservative financing. I'm a little bit debt adverse. I don't mind a little bit of debt, but I don't want more than 20% of the value of the property in debt, if any at all, because the cash flow and the tax strategies that we've got, I'd rather be like a lender than use a lender. And so we've set things up so that we can maintain at least the threshold that no property, I mean, a couple of our properties are free and clear, but no property is ever going to have more than 20% of its value in debt. I just don't want the risk if the market were to downturn unexpectedly and I've got a bunch of debt service that I can't, I just don't, that's too much risk for me. Property maintenance is an important factor because this goes into the active versus passive treatment. But there are things that you can do to enhance your rents. Giving tenants one price is one way to do that. Doing a rent survey, you'll actually come out farther ahead long term, and your property will outperform any other comparable on the market. It allows you also to diversify your portfolio by having property in this bucket. Stabilizes the total influence that it has over your entire portfolio and allows you to optimize tax strategies that allow you to do a few other things that might not be as easy to do in the other investment objectives. And we'll learn about what those are in the next course, because those are some pretty advanced strategies that really sophisticated investors have been using for a long time. And I want to make sure that you have that knowledge and information, because if you use them, they will pay you and reward you handsomely for using them. And then 5 is the wealth accumulation objective. Wealth accumulation is about adding more to that what I already have. I have one gold coin, I want to add another, and I'm now accumulating wealth. And it means that we're accumulating appreciating assets. Cars are not an appreciating asset. Collectible cars are still not an appreciating asset because of the tax traps. We want to acquire and accumulate wealth through a balanced portfolio approach that allows us to acquire assets that are going to appreciate in value, equal to or greater than the rate of inflation plus 3. Equal to or greater than the rate of inflation plus 3. Because if you can't do that, you're never going to stay ahead of inflation. And that is the hidden tax that we all pay. If you've been to the grocery store lately, pre-COVID, $100 basket of groceries at the grocery store today will cost you $147. That same $100 basket of goodies today is $147. Inflation is not about prices going up. It's about how fast the dollar's value is going down. And it is really being debased right now. So wealth accumulation is acquiring and balancing your portfolio in assets or asset groups that appreciate, that go up in value. Real estate, by far, hands down, will outperform, if it's structured correctly, almost any other asset group. It allows you, if structured correctly, to reinvest your rental income in a tax neutral environment and get a snowball effect that even that money that you're making is tax free if it's set up right. It allows you to leverage not only financing on the front end, but leverage the tax attributes that allow you to scale your investment strategy and do more with less. Market timing is not the same as time in the market. They're two different principles. Timing your transactions to leverage the tax attributes so that you take advantage of all of them in a concert or combination of strategies that are designed to keep more of your money both today, during the holding period, and at some point in the future on a disposition. Looking at the development of a project and what it can do versus what it will do is really about understanding the options and what the highest and best use analysis will tell you about that property. And then looking value added strategies. When we came up with the idea of giving tenants one price and it included everything, it was probably one of the smartest things we ever did. Today, our total combined utility cost, water, sewer, gas, lights, trash, everything, is running about 18% below the last 5-year average. And yet our rents are up 61% in 5 years from when we bought it. So we've got this huge spread that allows us to accumulate a lot more cash. That cash then gets invested in the market. And as it's growing and it's sitting on the sideline, waiting for the next deal to come along, when we find the deal, we're going to be ready to go. And every dollar has been working along the way and guarded against the overexposure of tax. It's really the only way to build a successful portfolio long-term and make sure that it's going to feed you for all the years that you fed it. You can go out and meet these people that have 200 properties and this, that, and the other, $50 million of real estate. I guarantee you, when you pull back the covers and go down a couple of layers in the onion, you're going to find that they're over leveraged. They have very little cash flow, or the cash flow that they have is being taxed in ways that they're not telling you. And it's really a house of cards that is not too far from what we saw in the crash during the 2008, 2009, when people were over leveraged in real estate then. We see a lot of it right now, particularly in commercial. I'm talking about owning property that's free and clear or nearly free and clear and paying you to own it through the tax strategies. Our net cost for Mohawk was $26,000 by the time we had the tax savings, the free cash flow, and the appreciated value that we've got in the property holding it for 5 years. It didn't cost us $979,000. It's only cost us $26,000. And it's worth almost $2 million today. I'll put that investment against any that anybody's got and outperform any other asset, because starting with where we started right now, having the investment objective clearly defined and understanding how you own the real estate and how you buy it and how you sell it will decide how you get taxed. Most people pay 50, 60, 70% more in tax than they need to because they don't have a plan. They don't have a strategy to keep any of the money. They've got a great strategy of making money. But by the time they sell it, the dust settles, and next year you file the tax return, and then you get the big surprise you got to write this big check for the taxes that you owe. I would have wanted to know that before I even opened up an escrow to buy it. If I was going to have that problem, because if I'm going to have that problem, I'm either going to find a way to mitigate it or I'm not going to buy the property. It's not worth the time and energy. I thought I was going to make 100 grand in profit, but after I paid the taxes, I made 20. Nobody wants to do that. That's too much risk. So basically, these are the principles. And I think what's exciting, at least for us right now, is that, just to complement this last strategy, long-term wealth accumulation, you're compounding your growth. You have strategic acquisition and portfolio management. You have an exit strategy that is complementary and tax-centric. It gives you the best of all worlds. Your entire portfolio is about wealth accumulation. And everything that you do with every property allows you to meet these objectives in a capital-intensive investment like real estate. All right, I'm just going to take a minute here and just give you the introduction. The next course is a 5-lesson course, Advanced Principles of Real Estate Investing. And we're going to take each of the 5 objectives and we're going to dive into them in great detail. These will be 75-minute courses. We'll be doing them on a Saturday morning again, and we're going to do them, I believe, starting next Saturday for the next 5 weeks and dig into this advanced course. We're going to give you the definition and detail of each of the objectives, the strategies for achieving them, examples and case studies, and interactive discussions on how you can apply the principles to your existing portfolio in your real estate investment objectives. And if you don't have that defined, I would grab the QR code and make an appointment and get a free evaluation and some direction to look at an assessment of your portfolio and to see what its real performance and equilibrium really are. What I'd like to do is just for a moment, stop this and give another, I want to show this worksheet. So hold on just a second here. And I'm going to find the worksheet. There we go. And then let me get I'm a little bit technology challenged, but no, I'm getting a little better here. All right, here we go. All right, when I talked about the pre-purchase analysis, the purchase analysis, and post-purchase analysis, what I'm talking about is what we use that's a little bit of an acid test. This spreadsheet was designed where you have this beige color are the input fields. Nothing else on this spreadsheet other than the name and the investor and the property up here in this section. Nothing else is an data entry field. The only data or information that we're inputting into this spreadsheet right here is the actual purchase price of the property, the proposed purchase price, the allocation of that purchase price to land. I'm not going to be taking that from the property tax assessment or the property tax bill. The property tax bill is not the appropriate source for how much you allocate to land. that allocation is only for the purpose of assessing property taxes, not income taxes or capital gain taxes. So there is a different approach to allocating how much of the property gets allocated to land, and then from the land portion, how much of that property land is improvements on the land, like fences, irrigation and sprinklers, sidewalks, driveways, shrubs, bushes, trees, landscaping. All of those improvements on the land portion are 15-year classified assets and are depreciable over 15 years. I never see that allocation correctly stated on a tax return. I just don't. So we do a lot of fixing tax returns to go back and calculate those things correctly. I want to know how many square feet of rentable square feet the property has. And it's going to have a factor, which is a rate per square foot using a rent survey approach, that I'm going to calculate the value of that rent, that I believe that rent value should be. I want to know the composition of the units. Are they 3-bedroom, 2-bath, or are they a combination of 2-bedroom, 1-bath, and 3-bedroom? I want to know that. And then I want to know the loan balance that I'm looking at. From an input data point, that's all I need to know on the property. And then it's going to give me an acid test, which is going to tell me whether I even want to look any further at the possibility of acquiring this property, because it's going to allocate automatically the remainder useful life of the building and its subdivision into 5, 7, 15, and 27.5-year asset groups, plus the improvements on the land as a 15-year asset group. And it's going to take all of that and put it into a depreciation breakout analysis for the next 1 to 7 year holding period. And it's going to tell me each year how much straight line method depreciation I get to deduct. And it's going to give me that total deduction. And it's going to tell me what my federal tax savings on that deduction will be for each year. And then at the end of 7 years, if I hold the property for 7 years, in this particular case, it would have produced $104,909 in tax savings. And that is going to be pretty much a guaranteed amount if I've got the right number in, because that depreciation, once you set it out, is not going to change for the foreseeable future over the 7 years, unless you add other assets to it. Then I'm going to get the GSI forecast using the rent survey approach. How much per rentable square feet am I going to get in rent? What my operating expenses are, and I take my GSI and I subtract my operating expense and my depreciation and my interest, and I have a taxable gross profit of negative 20,421 in year one. At the end of the 7 years, I've only had 93,807 in gross profit, but because I took a management fee with my management conduit corporation, I actually have a $69,106 tax loss over 7 years. I still have the money, but I don't have any taxable money. I have a tax loss of 70 grand over 7 years. What I have now is I have the basis of my property. I have a retiring debt. I'm not accelerating the debt, just retiring it. I built up an equity position plus my cash. So at the end of 7 years, I've got a return of $882,698 on an investment that was $615,000. I have no tax exposure. I have my GSI, my gross profit, my tax savings and cash return. Actual money in my hand is $256,125. So basically, the tax attributes and the rent survey have allowed me to acquire a $600,000 property. And basically, after holding it for 7 years, it gave me $256,000 more than what I paid for it. And I have no taxable income or profit when I dispose of the property. So yes, I will be making an offer on this particular property because this property can outperform. And unfortunately, the seller doesn't know what they actually have, or they would never sell this property. Not for what I can do with it. So this would be a no-brainer for me. This worksheet, we're making some final revisions and disclaimers that we have to put on it, and it will be available in the next week up in your back office for you to use. It will have a big disclaimer on there that you can't rely on it for investment decisions. You can't use it to give people advice, all of the standard stuff, so that if you use it inappropriately, at least I'm not going to be part of the problem. And we have to put disclaimers on that. I'm happy to help you develop one for your own real estate portfolio, which you should have, like we have, so that it's actually not only tax centric to your own objective, but it's defined by your own real estate portfolio. That's really the only way that you really want to have something like this, to use it, because it will give you a quick acid test if the property makes sense in buying it. And then I can show you how to fine tune the decision making so that you can see a little bit clearly some of the important data points that you want to pay attention to in your overall investment strategy. It's really a very powerful tool that we're thinking about creating an app and then a software platform that will allow us to make that available so that you can put multiple properties in or put your whole portfolio in and really do a deep dive analysis that will save a lot of time. And I think what's helping us make that decision is the advancements in AI are just phenomenal right now. And that's going to give us the opportunity to do more with less and a faster scale with the AI platform. All right, at that point, we reach my favorite point, and that's where I get to ask if you have any questions or feedback. I'm here to answer questions, have a short little conversation, and very exciting. And I'm looking forward to next week with the start of the new advanced course. And I think we've got 5 lessons, and I think John is helping me. I think we're going to do those every Saturday for the next 5 weeks.
Yep.
Get those done so we can help you go out and do a really good job on investing.
Hey, James, I don't have a question. I have more of a statement.
Yeah.
I just wanted to bring up for the group some of the stuff we were talking about earlier. What I really like about the tax centric approach, and then sort of this litmus test, and sort of what I really like is the fact that it takes emotion out of the ultimate goal, right? You know, because I could see a lot of people, and me as well, like you get emotional about this stuff. You get excited, or you get bummed, or you feel overwhelmed. Just do the math, and the math doesn't lie, right?
That's a good point.
Yeah, so it'll tell you whether, and like I said earlier, like if I'm going to get excited, I want to get excited because I made a good business decision, not about some fantasy numbers down the road. This will tell you what you need to know right off the bat, and it
Oh,
also
that's
helps
good.
protect you from the nightmare of making the wrong step. So I just want to, I do appreciate these lessons because, you know, when we're out here trying to wade through the information out here on the internet, it's always good to have somebody who's stepped before you, you know. So
That's a very good point. And you're right. I mean, and that's kind of sad. I mean, there's so much noise out there. You go to YouTube and there's just like a gazillion different people talking about this and talking about that, and real estate invest this and real estate invest. I have not found one that does anything about building a tax centric approach to real estate investing and understanding the tax attributes, that if you set the structure up correctly and your investment objectives are aligned with that or congruent with that, in a 5 to 7 year holding period, the tax savings are going to pay anywhere from 50 to 75% of the property of what you paid for the property. Your net cost, our net cost on Mohawk is $26,000. I mean, are you kidding me?
Well, and
We saved $70,000 a year on taxes. We have the excess cash flow that's not being taxed, and we have the appreciated value. Why would I ever think about anything else? But let me go find another one of those. We started out with a 4 unit. It's now a 5 unit, and I've rented out as much of the rentable square foot that you could possibly rent out. It's like crazy. Give me another one of those.
well, and you bring up another good point, which is the tax centric portion of this. There's a million ways to make money, whether it's in real estate or not. It's a very different animal to keep the money you make, or as much as you legally can keep, and that's missing from everybody that does business today. Like that's one of the main things I do appreciate about this perspective. So
We had a client the other day. Alan and I were talking to a potential new client, and in a 3 year period, their business grew from about 600,000 to almost $2 million a year business. But the thing that was scary and just crazy was that the rate of their taxes was accelerating at 2.5 times the rate of their income growth. In other words, their tax rates were rising 2.5 times faster than their income, and their income was growing pretty healthily, pretty good. And I said, in 3 more years, your federal taxes alone are going to be 250,000. That's $500 a day that you're going to be spending in federal income tax. I said, you've got a great plan for making money, but you don't have any plan for keeping any of the money that you're making. And you're talking to financial advisors that are advising their clients, and your tax trajectory right now is going to crush you in about 3 years. Crazy. And you're right. And I see that more and more every day. And and now that people are now selling property, and you've got boomers now trying to decouple, but they're looking at these massive capital gains taxes for holding property for the last 20 years. That's why the real estate market is contracting right now, because nobody wants to let go of the inventory. Not because they can't get the money, it's just they're going to pay 65% of that money in tax, and nobody wants to write those checks. Yeah. So it's going to be a problem for a little while until this settles out. But you make a very good point. Your business, everything that you do is going to have a tax impact. And if you don't understand that, then it's going to be probably an unpleasant surprise. What this model does is it takes away the emotion, and it's math, like you said. It either works or it doesn't work. And at least you have an idea about what to pay attention to before you make an offer on a property. I appreciate that you might like the kitchen and you might like the front yard, but unless that somehow is translating into you not paying very much in tax and you're making a lot of money on that kitchen and that front yard, that's irrelevant. It comes down to the numbers. And if you can't discipline yourself, this at least gives you the opportunity to do that and apply a discipline that will help safeguard your capital. So let's see, Juanita has her hand raised. I like that. I call on Juanita now.
Hey, James. So did I understand correctly that for this strategy to work, you can only hold your property for 5 years? I mean, you have to sell it?
No, in this particular case, the holding period would have been defined as 5 to 7 years. And so we want to do the analysis out 7 years. We've got property, we've got people that have property that they're going to hold for 15 or 20 years. So we can do the point is, how long are you going to hold a property needs to be part of the acquisition model before you buy it, so you have some idea how long you're going to hold it, because the tax composition and the tax attributes are going to be different.
Okay, so then you do have to plan to sell it, right?
Well,
Yes,
you
sir.
have to plan on a disposition, whether that's a sale or a 1031, or if it's going to go into your charitable remainder trust as part of your legacy. Every property has to calculate what a disposition would look like. Whether you do it is a different question. But if you were to sell it, what would that look like? If you were to sell it in 10 years, what would that look like with what we know today?
Okay, because, so one of the strategies that we've been following is you hold your property for 7 to 10 years because around 7 to 10 years, rents double. And then at that time, your equity goes up, so then you can take money from your equity tax-free. So I didn't know how that will play into like this strategy or if it even plays at all.
How do you take the money from your equity tax free?
Um, you just pull it out. You just pull it out, so there's no taxes on it.
But how do you pull it out?
Oh, I'm sorry, you have to do a refinance.
Oh, all right. Well, here's the danger. Here's the danger. Do you know what interest rates are going to be in 7 years?
No,
Yeah, well, people 7 years ago didn't think that we would have 7.5% interest today.
right.
And if you can't get financing because of the structure and you can't get finance, and if we're guessing that the rents are going to double in 7 years, I would rather know with a little bit more certainty that my rent model at least is going to have a better chance of doubling. And I probably am going to lean heavily toward a rent survey rather than a rent comp. And I'm going to look at the performance of that. The other aspect of that is the asset underperforming or overperforming? When you can have the property disposed of in 7 years and take all of the gain and not pay tax and go into a new property at 2.5 times the rate of return, is it the highest and best use of the property to keep it 7 years and hope that you can borrow money against it? If the lender is going to loan you the money and you're counting on the interest rate, then a hedge against that would be to be invested in bonds. Because if you get it wrong, at least you're not going to lose as much money because you had some of that sheltered in bonds. I would venture that you can be in a better position with less debt using a different strategy, but complementing the strategy to accumulate more real estate. The leverage part of it and pulling that out is going to be dependent on the economy and the prime interest rate. And that, just inherently, that's got a lot of risk to it. So just be aware of that.
Yeah, you make a really good point. So we've been following this strategy because it's the only one that's made sense so far. But
Well, I think you've got 2 or 3 other strategies that make imminent sense to look at the property from a different viewpoint. You've got what I can recall, and I'll certainly have Alan pull your file and get up to date on it. But from what I recall, you've got some opportunities that probably you're not even aware of. And I think we should maybe look at those and see if you have a different way to look at the asset group in terms of what other opportunities you might have. You actually might have more opportunities than you realize.
No, I appreciate that. Because the interest rate issue is a definite risk for sure.
They started out in January saying we were going to have 6 rate decreases this year. We won't even get one, not even one by December. There's not going to be any rate decreases. It's not going to happen.
Yeah. All right. Well, thank you so much. I appreciate you answering the question.
My pleasure. Always my pleasure. All right. Any other questions? Cool. Then I did a good job, I'm assuming. Anyway, next week we will begin our advanced course and we're going to get deep in the weeds. Each of these investment objectives, and I think here's the question to ask yourself and reflect on. Why did I buy the property on Elm Street? What was my investment objective for the Elm Street property? What was my investment objective for Mohawk? What was my investment objective for 72nd Street? And then look at the property today from a critical and subjective view. Is the property's performance, its financial performance, meeting my objective? If it's not, then what can we do to tweak or fine tune the property so that it meets your objective? And if you didn't have an objective as defined by the 5 real estate objectives, investment objectives, then maybe that becomes our starting point to look at what we call a portfolio assessment, where we take the weight of the entire real estate portfolio and we put it on a spreadsheet and we let the data tell us whether we have weakness or not, where the weakness might be, and what we can do in at least refining or developing an investment objective, and look at the opportunity that we have. That analysis, I have never charged a client for that analysis. That's a free analysis that you should always take advantage of. Because if you don't know where you're at, that would be the first thing I would want to find out is, where am I relative to my real estate portfolio? Because how are you going to get to where you want to go if you don't know where your starting point is? If you don't know where you are and you want to go to New York and you don't know where you're starting from, well, if I'm in New Jersey, that's a pretty short trip. But if I'm starting from San Diego and I want to go to New York, I got a long haul. How I'm going to get there is going to be, I can walk, I can take a bike, I can take a train, I can take a bus, I can drive, I can take an airplane. How I get to where I want to go is going to be your investment strategy by analogy. Okay. And if you don't have that defined, then that's our starting point. That's where we start. Because you can make up for lost time by just making some little adjustments now, where you're not at the tail of the wind, you're at the head of the wind. And that's where I think the average investor loses so much momentum and so much opportunity to make those adjustments, because they're so deeply tied emotionally to the property or to their decision that nothing else is you don't have visibility on anything else. What this process does is it allows you to take the emotion out of it and really ask yourself the real important question. Is the property performing and meeting my investment objective? And if it's not, then what can we do so that it does? If it is, then great. Let's do more of that. But let's do it in a way that we're not taking on more risk. We got to preserve our capital, and we've got to preserve every part of the wealth that we're accumulating. And overexposure to tax and risk, those are the things that'll take that momentum and take it away. All right, have a great weekend, everybody. We've got the 4th of July coming up next week, but we will be here next Saturday, starting the new course. We'll spend the first lesson on the passive, but we'll get a little bit of a primer and some examples and some considerations of why it makes sense and things that make sense when you're looking at passive income, particularly at a point where maybe you have a self-directed retirement account that's doing a lot of your investing in real estate, where you can build your retirement plan in a little bit of a different way and take a lot of the risk out of that and actually have some more benefits in terms of long-term planning. With that said, have a great day, and I will see everybody next Saturday.